Think of a one-of-one baseball card. You can't replace it if it's destroyed. So the replacement value is irrelevant. Insurance policies are designed to indemnify the policyholder for certain losses. To indemnify someone means to return someone to the financial position they were in before they experienced a financial loss. Your bike gets stolen. That's a financial loss of whatever you paid for the bike. If you were to be indemnified for that loss, you might get a new bike, or you might get money based on the bike's value. An insurance settlement is whatever form of indemnification the policy is designed to provide. All insurance policies describe the types of settlements available for different types of losses. Let's take a look at common settlement options. Insurers don't just pull numbers out of thin air when they offer a claim settlement, nor do they automatically pay whatever their customer wants. Settlements are calculated based on the policy terms. Settlement options differ depending on the policy and the type of loss. There's replacement cost. That means the settlement will be based on the cost of replacing the damaged property with a new object of similar kind and quality. There's guaranteed replacement cost, but it will pay the replacement cost even if it's higher than the policy's coverage limit. There's actual cash value. This is, once again, the cost of replacing an item, but this time with depreciation factored in. So old items have lower actual cash value than similar new items. There's also market value. That's the value of property if it were put up for sale. Most of the time, the market value of an item is less than its replacement value. Think of an old TV. If you put it in a garage sale, you'd be lucky to get $100. But the cost of replacing it with a new, similar TV would be over $1,000. On the other hand, think of a one-of-one baseball card. You can't replace it if it's destroyed. So the replacement value is irrelevant. But its market value could be tens or hundreds of thousands of dollars. That brings us to one more settlement basis. Agreed value. Agreed value means the policy will pay a specific amount for lost or damaged property, an amount that the insurer and the policyholder will have agreed to before the loss occurred. Most of the time, a policy will feature more than one settlement basis. For example, many policies offer replacement cost coverage if you do, in fact, replace an item. But if you choose to take the cash settlement, it would be based on the actual cash value. Stuff that was broken down and unusable before a loss might not qualify for replacement cost coverage. Let's look, as always, at a quick example. Imagine you just had a little fire in your kitchen. It damaged your cabinets, appliances, pots and pans. So you make an insurance claim. Your policy states that if you repair or replace damaged property, it's on a replacement cost basis, unless it was in unusable condition before the loss. Here's how the adjuster might break it down. You need to get a new dishwasher and oven, fix the cabinets, and replace all the plates and glasses. The adjuster figures that the total cost for this will be $10,000. Except your dishwasher was old and decrepit. You hadn't used it in years because you love hand washing dishes. This is a make-believe situation, remember. So, instead of a $1,000 replacement dishwasher, you'll get a $50 actual cash value settlement for it. That's $9,050 covered by your policy, minus your policy's deductible of $500. Your insurer's settlement offer is $8,550. Most of that would go directly to the repairs and replacements. But you can use that $50 cash settlement for whatever you like. And that's the rundown on insurance settlements. For more insurance definitions and other helpful videos, just hit subscribe. To get a home or car insurance quote, visit squareone.ca or click the link on the screen. Thank you for watching, and I hope you found this helpful. Let there be words!
Sharp and fast.
Okay.
Ready?
Oh, baby.